Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have the Frac Spread show, and so we're going to talk about the frac spreads, we're going to talk about the duct count, and then I really want to dig into the commentary that's been coming out of the White House regarding the potential ban on refined products, what the different flows mean, because I think it's really important to understand that the more you get in the way of economics, the more knock-on effects that it will create. And we're going to talk about trade and how some of those pieces will get shifted, because I think it's important to appreciate the importance and the balance that we're trying to strike, and where the differences are between Pad 3 and Pad 1. Where are they? Why is this the case? So before we get into that, we want to look at the Primary Vision Frac Spread Count, which went up by 1. So we went from 283 to 284, and the biggest shift was in the Western Gulf. The Western Gulf had a nice addition. The Williston had a small drop, which netted out to +1, but everything else was fairly stable. As we've been saying, we expect the Permian to add about another 2 to 3 spreads. We expect the Williston to, again, the drop was more of like a moving day in terms of one location to another. It's all a matter of when is it struck, when do they get to where they need to go. And then we do expect to see the Western Gulf as well as the Anadarko add some additional capacity. Now, in relation to Anadarko, we've had more commentary out of Westlake that they dropped, they cut some of their utilization rates, but a lot of that was due to brine quality, unplanned maintenance, and planned maintenance, and not because of demand. But again, as we said earlier with Olin, they cut 2 facilities and then they're reducing another, which I think is important. And they highlighted Western Hemisphere demand as being soft. And we all know what PVC goes into and what are some of the issues with that. So that should drop a bit on local NGL demand, but as that drops, we've seen a big shift higher in exports. So again, it's just a matter of we expect a natural gas liquids pricing to remain here, and the cap is going to be, or I should say the ceiling is going to be driven more based on lower U.S. demand. And but when you look at the export market, that's going to keep us. That's going to be the floor. So again, there's some of that push and pull, which I think is going to keep us fairly well situated where we currently are. Now, when we shift to the rigs, you can see that there was a total of 7 additions: 6 horizontal, 1 directional, 4 oil, 3 gas. One of the things that we're going to talk about in a minute is the Haynesville continues to add the duct count. Now, obviously, Freeport has announced a force majeure. I should say Freeport LNG has announced a force majeure that extends into September. So the Haynesville's going to be one of those pivotal pieces where they'll come on and they'll try to probably match up a bit, create some of that duct count. But while Freeport is down, we still have other facilities in the U.S. that are running full go and sending more product into the international market. So again, when you look at the LNG market, when you look at what's happening in Europe, we expect to see more demand, and they're again going to remain a very active participant in this market in general. So again, one of the things that we've been saying is that rigs were going to continue to outpace, but it takes time to see that catch up. So when we see the data that has recently come out for May, when you look at the drilled but uncompleted wells, one of the things that we've been talking about is the rate of change was going to shift sharply. And it was really going to be driven based on, a steady increase in rigs, a little bit of a flattening out in frac spread counts. And that was really going to adjust where we had a very steep drop. But when you look at the last 2, we started to see some of that adjustment. And now as we go into June, we expect to see this actually flatline and likely start to increase a bit, because we will get some of that capacity that will be needed to really push those the increase in production as we go through the summer months. Especially realistically, when we say that, we should say between July and September, we do expect to see a fairly sizable push on the production front, which is why we've been talking about that 300 to really that top peak realistically of 315. But again, that 300 is a very doable number for the frac spread count. So now when we look at the DUC count and just breaking it down by some other regions, here you can see that the Haynesville is almost back to an all-time high on the drilled but uncompleted wells. Again, there's a mixture of just activity coming through, but at the same time, natural gas liquids continue to be a bright spot. And Freeport has obviously shifted that a bit, but one of the things that's important is we have a heat wave in the U.S. We still have our own storage to fill, and we do have elevated local demand. So obviously the heat wave plays into that. And then we do have facilities that are still operational. So again, there's still going to be some of that pull through. But when you look at the Bakken, the Eagle Ford, the Permian, you can see that they're all starting to flatline. And as they flatline, we expect that to start to creep higher as we see more activity essentially ramping up through the summer months. Now, as we look at this and we look at the activity in the U.S., as we've been saying from before, we expect the exit rate of 2022 to be 12.2 million barrels a day. Nothing has changed that. I think we're still right on target. That's a call that we made back in really October of 2021 when we were projecting forward on what that exit rate would be. And so we do think 12.2 million this year, and about 12.5 to 12.7 next year, depending on, a lot of things obviously can change. We're only in June. So when we start looking at how things are positioning and what that shift entails. Now, it's important to look at what is the global market doing, and we've been talking about this for a while, so we want to start with Singapore. Singapore, you can see that there was another build in light distillates, which includes gasoline. Gasoline still remains at record highs. Middle distillate had a sizable build, and again, sizable build from a very low level. But it's going to be important to watch about middle distillate and residual fuel, because are we starting to see some of that flip where emerging markets are like, I can't afford middle distillate diesel, which is very low sulfur, ultra low sulfur. We're going to buy the high sulfur fuel oil, the residual, because we need to keep the air conditioning going. We have to keep the electricity flowing, and diesel is just too expensive. That's going to be something to watch. And if the middle distillate fuel stockpiles go further up, that will incentivize, let's just call it a swap between Europe and Asia, where Europe will send fuel oil and they will import additional middle distillates. Just recently, the data came out today, the imports of gas oil and diesel into Europe is at a 20-month high. A lot of that has been coming in through the Middle East, and then obviously some from the U.S. as well, which again leads us into, well, what are we talking about when we start looking at the export market from the U.S.? Because remember, the U.S. exports from the Gulf of Mexico, which is PADD 3, and unfortunately I forgot to put a slide on the pads, but I'll add that in the EIA show next week. So when you look at the shifts, PADD 3 is the Gulf of Mexico. So the Gulf of Mexico has excess refining capacity. So we export from PADD 3. But PADD 1, which is the East Coast, PADD 5, which is the West Coast, they don't have enough refining capacity, so they are net importers. So if we were to stop exports from PADD 3, which is already well supplied, well, then we would drive up the price of the international market, but PADD 1 and PADD 5 still have to import. So you're going to actually drive up the prices of what they're buying by trying to bring that down. Now, there's ways that you could adjust that, which we'll go through in due time. But that's the crux of kind of what we're looking at and why that would really be a much bigger situation. Now, that's just the economic side of it. Now, the other side of it is we're sending product, gasoline, into Latin America, and with Mexico being our second largest trade partner. And if we stop gasoline going down there, what does that do to their inflation? What does that do to their gasoline prices? And then what does that do to the import prices into the U.S.? So again, there's a lot of knock-on effects. And then what are we going to do for our allies in Europe that are standing behind us in terms of what is happening between Ukraine and Russia? So it just seems like there's a lot of flailing around in terms of what the energy policy needs to be. And as I think Twain's mustache says on a regular basis, energy ignorance has consequences. And again, we think that there's a lot of great people in the U.S. that would be happy to help the government, myself included, come up with a meaningful way to address these issues and to really look at them from an economic and strategic manner. So when we look at refinery utilization rates, and some of these are going to be pulled from the EIA show, but just breaking it down a little bit differently. We're not going to look at the changes and the shifts. We want to look at holistic numbers. So when you look at PADD 3, which again is the Gulf Coast, has right now has 8.9 million barrels a day of refining capacity that's active right now. PADD 1 has 789,000. So you're talking about 8.9 million versus 789,000. So when you look at the shift, it's just how are we going to get product from the Gulf of Mexico into PADD 1? How are we going to adjust this in the Atlantic Basin, which is a massive basin, but is attracting a significant amount of refined product? And how do we make sure that those prices are as low as possible to protect against inflation and really hit that from the diesel gasoline side? And I think these are some key pieces where PADD 5 is at 2.1 million barrels a day of throughput. And a lot of that it's come down over time as we've shuttered, like a PSX's Alliance was shuttered in PADD 3 after the flooding, just because it cost too much to bring it back. We haven't had a new refinery in the U.S. built since 1978 or 77, within that late 70s period. Are we going to start sanctioning refiners? Which is fine. Let's sanction them. Let's rebuild them. But it's unlikely that that's going to be the case, given that the mantra has been that gasoline is bad, diesel is bad, we need more EVs, but yet we need EVs, but EVs and the inputs into the EVs are mined, shipped, and moved about by diesel. So again, you start to come to this conundrum, especially when we start looking at the diesel picture. So one of the key ways to get product from the Gulf of Mexico up into the Northeast and the East Coast in general is the Colonial Pipeline, as we all remembered when there was a cyber attack that shut it down, when we saw what the impacts were. You can see that line 1 and line 2 are the key pieces that go from the Houston up into and then terminating in Linden, New Jersey. And you can see that there's offshoots throughout, but it's a pipeline that has a fixed capacity. There's no ability to increase that past a certain point without risking a lot of specific problems. So when you look at and what those problems are is, you have a pressure issue, you have a pricing mechanism. So realistically, the Colonial Pipeline is tapped out. So the only other option if the Colonial Pipeline is maxed, is to go to the floating market and to export on a boat from Louisiana, from Texas, into parts along the East Coast. The problem is you can only use a Jones Act vessel. A Jones Act vessel is something that is built and manned, operated out of the U.S. So it has to be built in the U.S., it has to have a U.S. flag on it, and it has to be manned by U.S. sailors, which is all great, but we don't have a whole lot of them. So you're talking about a smaller pool that you're competing for to get them through. So in periods of crisis, whether that be a hurricane or some other sort of catastrophe, the government will waive the Jones Act, which will allow a foreign vessel to take different products from one U.S. port to another U.S. port. And that's the key piece. To go from Houston to New York Harbor has to be a Jones Act vessel. So again, if we were going to stop, let's just say for an example, we're going to stop exports or at least put a ceiling on exports, we would have to enable these companies to move the molecule at the cheapest way possible, which would be a waiver of the Jones Act to ensure that we have the availability of boats and ships to get this to where it needs to go. And here's why. So when we look at gasoline, gasoline in PADD 1 is 52.5 million barrels. PADD 3, it's 82.7. So you hear those numbers and you're like, okay, well, what does that mean? Show me in a chart. So when we look at gasoline storage, there's only been 2 years over the last 29 that gasoline storage has been this low in the East Coast. So when you think about, well, where is their pricing? How is that driving things up? This is a key piece. When you look at storage, the refiners there and the blenders in the East Coast are saying, well, I need products, so I have to go out and buy it on the floating market, which is why imports have been over a million barrels a day. And the reason, and a lot of that is coming from Europe, because Europe has that excess. But it's still, the ARB has to be open for that to happen. Now, when you look at Pad 3, this is the fourth most gasoline that has ever been in Pad 3 storage. So again, it's not a matter of do we have enough gasoline, is it in the right place? And if it's not, and so because we're weighted to the Gulf of Mexico, they're going to export some of that excess, especially into Latin America, which are very pivotal trade partners, especially after the reconfiguration of NAFTA and the movement for what we like to call nearshoring. So if you think about the supply chain, we're trying to bring our supply chain closer to the United States, and we're going to penalize our partners in doing that, or you have to think about this critically when we're looking at how are we going to incentivize companies to go from Asia, from China specifically, closer to the U.S. or within the U.S. And again, these are some of those key pieces that we have to look at. Now, the distillate side is something that's actually much worse versus gasoline. And that's why, and I had this conversation on Twitter with Craig and I believe Gas Buddy, when we're looking at some of the different backdrops. Diesel's in a very different position. So gasoline has an abundance in Europe, an abundance in Singapore, but it has to get there. So you have to bring it over. But distillate is short around the world, and that's the biggest problem, which is when you start looking at the different shifts and why diesel prices are so high at the coastal market. And the reason why that's important is because California is where a large part of our shipments originate. And California happens to have some of the most expensive diesel in the world. So when you're thinking about the cost, how that impacts the supply chain, you get an idea of those knock-on effects. So when we look at this, Pad 1 is 19.5 million below the 5-year at 26.6 million. Where Pad 3 is at 40, which is only 5 million below the 5-year. So again, when you look at the different backdrops, in the last 29 years, this is the least amount of distillate ever in Pad 1 storage. So if you need diesel in this market, if you need heating oil in this market, Pad 1, the East Coast, has to go out and compete against Europe, which also has a record low, that has to compete in the market to bring this product in to essentially make up for the difference between what they can produce in the refiners in the region and what they can pull from the Colonial Pipeline. So again, you're looking at the pricing metrics. So if we were to cut the exports out of Pad 3, well, that means that when you think about where is all of this flow going to come from, and then that's gonna take supply off the global market and drive up those prices, which is going to hit areas that we don't want it to hit. And this just gives you an idea that we're still fairly tight on even in Pad 3 diesel. We're still over that 29-year average. You know, we're in a comfortable spot, relatively speaking, but it just gives you an idea that there's still some of these issues. And when you think about exports have been moving. Gasoline has been fairly heavy, but when you look at the storage side, we have excess storage, gasoline and storage in Pad 3. So that is free to go, and we can help our partners. And then if you look at distillate, it's like, well, the distillate can't get to where it needs to go. So how about we go help our European partners and allies with that distillate that we have available? And then it also helps U.S. companies because they're maximizing profits while trying to take away the highest bidder. Because if you are an economic beast, you're going to try to, again, sell to the highest bidder. So if you fill their bid, that usually means that if you're filling the bid, adding volume, the next bid is going to be below that one. So the more volume you can put into the market, the more you're able to take down the overarching price yes, you're making a profit, but you're also bringing down those costs, those prices. Now, it's also important to appreciate cost. How do you make refined products? You need natural gas, hydrogen to crack it, to keep the fire and the pilot light on. So you need natural gas, you need hydrogen, you need different catalysts, and at the same time, you need different types of oil. Not all oil is created equal. So yes, you can look at the market and say, oh, well, WTI is 109. It's like, okay, but are we using WTI? Are we using 7 different grades? Agena is $13 over dated Brent. You have USAN, which is $8 over dated Brent. So you have to look at what is being imported and what is being consumed. Yes, refiners are making a profit, which they haven't for a fairly long time when you look back through the last 15 years, which is why they've shuttered refiners. They've converted them from cracking oil into renewable fuels. There are some of these key pieces that we have to consider, and it's important to understand how they operate. Now, when we think about the size of the impact to our trade partners, Mexico is $618.9 billion of total trade. So if we were to increase their cost, that would what do you think they would do? They would keep their prices the same, or they would increase their prices based on the fact that it's going to cost them more to do business, which is going to increase our inflation because we will import that inflation. So we'll stop exports into their country, force them into the international market where they're going to have to pay more for product, which means that their operating costs and their fixed cost, their variable costs are going to drive higher, which will then raise their prices, which we are going to import. So again, you're seeing so many of these knock-on effects that are very important to consider when we're discussing these shifts in economic policy. So now when we start looking at the periodic table of oil, and I know I've shown this many times, I still love this chart. It shows the different types of oil, and each one prices differently. So you can make a rudimentary number off of a 3-2-1 crack, which means 3 barrels of oil, 2 barrels of gasoline, 1 barrel of distillate, and you can come up with that number. But again, a refiner is using organic chemistry, which is a moving beast. How much motor gasoline are we going to create? How many blending stocks, alkylation, alky components, reformate. There's so many different processes that go into it that it's not just a one shot, one fix. And it's important to appreciate that in backwardation, you're pulling through what you can, and you're actually losing money on that time spread. So there's back and forth with all of this, which is why I find it funny, and it shouldn't be funny. But again, these are some key pieces. And then when we look at crude oil inputs into the U.S., the average refiner in the U.S. is operating something along the lines of 33 API, and then at a sulfur content of about 1.3. So there's also a very specific type of oil that has to be used or blended to these gradients in order to maximize profit. And the problem is the crudes that we're making in the U.S. don't fit that mold. So we have to export the excess that we can't consume internally and then import that difference. So we're still beholden to that international market, and we're price takers on what is that medium sweet, that heavy sweet barrel, and even those sour barrels, because we have to take what is out there. And then we've seen, when we look at what the U.S. has done, they've banned or at least put a moratorium on new permits in the offshore space, while permits with onshore continue to go up. But the offshore space is where we get those sour, heavier barrels versus what we're getting on the onshore side. So yes, shale is important, and you can see it's a big component of what we have, but we need those heavier barrels, and that's when we have to go to Nigeria, West Africa, Latin America, and we have to go to the Middle East to find them, import them. So if you think about if we could produce more product locally within the Gulf of Mexico, we don't have to go out and find it. And if you think about Pad 1, well, Pad 1 was importing from Russia. Now there's sanctions on Russia. So how do you make up that difference without adding miles per ton? And what we're doing here is we're adding miles per ton by not allowing more, again, production to be looked at, explored, and created in the Gulf of Mexico. We then have to extend out and go to Nigeria, go to Angola, go to Brazil, go to Saudi Arabia, Iraq to get that oil, especially because we're not pulling it from Venezuela anymore because of sanctions. So we can't go to Venezuela. We have to go elsewhere. And these are some of those key pieces that we have to look at and really evaluate on an economic level, but also knock-on effects that could really create where, okay, we alleviated one problem, but made 7 others. And then if we tackle those other 7, it created another 45. And again, when you push on an economic string, it has knock-on effects that you may not see or appreciate right away. That is second, third, fourth derivative that may be worse than what you initially tried to fix. So that is my rant. I apologize if it sounded like I was ranting, but these are things that I think can be addressed in a meaningful way with a lot of dialogue and understanding the way the industry works and the way the global markets are shifting. But my phone is always open. I welcome the opportunity to have these conversations and positive dialogue to move the ball forward. And again, create solutions. Don't just sit there and yell, you're a bad person. It's like, no, it's like, okay, you're misunderstanding the situation. Let me explain the situation as we see it. Explain it how you see it. Where can we agree on ways to make this better? And then how do we address it? And those are the dialogue that I hope to get back to after what feels like many years of it not being the case. So that's what we have for you today. Hopefully you have a great, I know for some you might have an extended weekend because of Juneteenth, which will be celebrated on Monday. And for the dads out there, happy Father's Day. So we hope you have a great weekend, and thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.